In the fifth and final short video on Greece, we're going to ask the question, would the Greek economy be better off outside of the Eurozone than staying in it? This, of course, is the question about Grexit. Grexit doesn't necessarily mean Greece leaving the European Union. It would mean Greece leaving the single currency. A single currency that Greece joined on the 1st of January 2001. Lots of economists and analysts writing about potential Grexit. Support for the EU in Greece is lower than in any other European country. And Paul Krugman, writing a couple of years ago, made a strident point. It's becoming increasingly obvious that Grexit is Greece's best hope. Otherwise, where is economic recovery ever supposed to come from? Joseph Stiglitz has written a book recently about the structural problems in the Eurozone. And he argues that currencies come and go. Would Greece necessarily be better off by remaining inside? So 2 slides coming up. One slide thinks about the benefits of Grexit. To what extent would Greece be in a better place if it left the single currency? Well, one benefit would be that there's the chance of export-led growth, because if Greece decides to leave the euro and go back to the drachma, then there would undoubtedly be a devaluation. The drachma would not be as strong as the euro. By some estimates, the drachma's fall could be 20 to 40%, which would make Greeks' export industries more competitive. Higher import prices would also help maybe some Greek domestic producers be better able to compete in their own markets. And a spurt in inflation would help Greece in some way to reduce the real value of their existing debts. Leaving the euro would give Greece a degree of autonomy, freedom to run their own independent monetary policy. And if inflation goes up, then that would bring about a period of negative real interest rates, which could be the monetary stimulus needed to help Greece avoid the deflationary trap. A big question in terms of benefits is the extent to which, if Greece leaves the euro, the imposed fiscal austerity from the Troika would come to an end. Would it allow the Greek government, for example, to increase their own investment spending? And there are some economists who point to the example of countries such as Iceland, which had a devaluation and a major banking crisis, a big spike in inflation and unemployment, and a big fall in output when that happened. But their economy seems to be recovering fairly well in the 3 or 4 years since the devaluation. So there are benefits to leaving, but of course there are also some costs, some significant risk factors. Let's have a look at some of them. The first is pretty obvious, isn't it? That if Greece devalues, then there would be a significant spike in the rate of inflation. In particular, the cost of imported energy and food and basic raw materials. And there's a case for saying that increase in inflation, which would potentially take Greek inflation well into double digits, would affect the poorest most. It would have a regressive effect on low-income households. Some people argue that actually if Greece leaves Grexit, there's a clear imperative incentive for the Greeks to turn on the printing presses to pay off their debts, and that could lead to hyperinflation. And higher inflation in the short term would certainly probably bring about increased interest rates by the Central Bank of Greece, which would make mortgages more expensive. In the immediate period, both before and after devaluation, there's the risk of huge capital flight from the banks as depositors look to take their euros out of the Greek banking system and place them in safer havens. Would Greece have to have a period of severe capital controls? The spike in inflation would probably cause quite a steep slump again in real output. Greece has already suffered a 25% fall in output since 2007. And if Greece devalues and defaults on some of its debts, other international creditors will probably never lend to Greece again at an affordable interest rate. There'd be a one-off shock. They'd get their fingers burnt, and they wouldn't want to get their fingers burnt twice. There are also some concerns that actually Greece is not well placed necessarily to benefit from a devaluation of their currency and a move from the euro to the drachma. Greece's export capacity is fairly limited. There's been a steep fall in investment in the last 10 years. So does Greece have the supply side capacity to gain from devaluation. And although the tourist sector might well benefit from a devaluation, it's actually done pretty well in recent years, in part because Greece has the euro. There's no guarantee, for example, that the Greek tourist sector has the capacity to be able to meet the increased demand if Greece moves to a lower exchange rate. And finally, if Greece leaves the Eurozone, that could, in theory, trigger a process by which Greece perhaps leaves, such as the UK leaves the European Union. Now, Greece relies heavily on structural funds from the European Union. Greece is a net recipient of EU money. And of course, there's a threat that money would come to an end. Would the Greek government be able to overcome that? So Grexit is at the moment a possibility, I think, rather than a probability in the near term. But things can change very rapidly. In our series of 5 videos, we've looked at prospects for the Greek economy. And I hope over the course of the 5 sessions, you feel that your general knowledge and awareness of Greece has improved, so you can use this as a case study in exam questions. Thanks for tuning in. Check out our other videos on the YouTube side.